Welcome to The Rubber Meets the Road Economics, the podcast where we explore the driving forces behind today's economy and their real-world implications. Join investor Hunter Craig as he interviews Professor Edwin Burton from the University of Virginia, delving into the complexities of economics with clarity and insight. Whether you're an economics enthusiast or just curious about how economic policies affect your daily life, you're in the right place. Let's get started.
Today is June 4, 2024. We're here with renowned econ professor Ed Burton. Professor, thanks for being here.
Good morning, Hunter. It's great to be here. Great to see you. I call him, for those listening, Hunter the Great, because he's a great guy.
You're kind. You're too kind, but thanks. The world is unsettled at the moment. Everybody is interested in the economy. But before we get to that, would you mind give us a background? How did you become a professor at the University of Virginia?
Well, I've been a professor all my life. When I was 26 years old, I stepped on the grounds of Cornell University as a young assistant professor, and I was there 11 years. And at one point, we bought a farm in Albemarle County, and when the university found out I was in the area, and that's almost 40 years ago, they brought me in as a professor, and I've been there ever since. I've now taught more juniors and seniors than anyone in the history of the University of Virginia, and no one will ever catch me. But paralleling that, I spent also 40 years in Wall Street. There's sort of two me's. There's the me that's in the academic world, and the me who ran derivatives for Smith Barney, which is now Citigroup's derivatives operation. I ran investment banking at a regional in Charlotte named Interstate Johnson Lane. That's part of Wachovia, became part of Wachovia, which then became part of other things. And I was kind of early forerunner of the hedge fund movement, doing arbitrage transactions. I also ran trading for Rothschild, the European Rothschilds. Evelyn Rothschild of the British family was chairman of the board. So I'm kind of one foot in Wall Street and one foot in the academic world.
And where did you get your PhD, and what was that like?
My PhD was from Northwestern University. It was an absolutely great department. I had been an undergraduate at Rice, actually played on the tennis team there, and majored in math and economics. I went to Northwestern, and it was a great place to be, but I was at both schools, University of Chicago as well, because when I wrote my dissertation, I needed a professor who was at Chicago, a Japanese professor named Hirofumi Uzawa, who was one of the most famous economists that ever lived. And I studied with him as well as with the Northwestern group. One of my mentors who was on my committee was Dale Mortensen, and those who follow Nobel Prizes, Dale got the Nobel Prize in economics. One of my students also got the Nobel Prize. So I've had both sides. I've had professors of mine who won Nobel Prizes as well as students of mine.
It was Milton Friedman. Was he at Chicago at that time?
He was, and I went to all of his seminars. You couldn't be around Chicago without the influence of Milton Friedman. He was a dominant figure, maybe the smartest economist I ever met. He could see things that the rest of us mortals really couldn't see. He could look at these mathematical models, and he could tell you the essence of them. It was really amazing. Normal people can't do that. But Friedman could, and there have been a few economists in history that had that ability. I would rank Friedman among the 4 or 5 most important economists in history. And if you want to know who the other names are, they would be Adam Smith, David Ricardo, John Maynard Keynes, and Friedman. Those would be my picks of the 4 best economists in history.
Professor, everybody is unsettled today. The yield on the 10-year is 4.35. Where do you think rates are going? Where do you think the economy's going? Where are we, and where are we headed?
Well, everything's going to depend on inflation in terms of the question that you ask. And the big issue right now is, what is the rate of inflation? Is it 3% or is it 4%? And the numbers that the Fed is looking at seem closer to 3%. And if you believe that, if you believe the Fed models, then you believe the 10-year will settle right about where it is, between 4 3/8 and 4 3/4, which is more or less where it's been trading. So if you believe the 10-year is the best barometer, then the Fed idea that inflation is 3 is on target. I don't buy that. I think the inflation rate is probably closer to 4, because we still have an enormous amount of money to work through. We increased the money supply from 2009 to the current date by roughly around 140%. That's how much we increased the money supply. And the recent period from start of the pandemic, we increased the money supply by 50%. We went from 14.5 trillion to 22 trillion in M2. That's one of the measures of money. That's basically the coin and currency that you hold in your pocket, as well as your checking accounts and savings accounts. If you total all those, that gives you the so-called M2 money supply. That went up from 14.5 to 22 trillion in 16 months. That's unprecedented. Never in American history, even during Lincoln's greenback days, have we increased the money supply that fast. And if that works and you don't get inflation, why do you tax people? Why not just do the same thing? Just ask the Federal Reserve every year to give you $5 trillion. They can push a button and give it to you, and the government can just spend that. Well, we know why that won't work. we know instinctively. I can convince an 8-year-old child what would happen. What would happen is you'd get inflation, and we essentially did the same thing during the pandemic. I remember when in the last year of the Trump administration, that was when they closed the economy, as you know. And at the same time they made output illegal, they increased the money supply by 50%. Now, what do you think is going to happen to the value of money if you do that? Anything you increase 50% when everything else was held constant, it's going to lose value because you've supplied an enormous amount of it. And so I wrote my first article about inflation, and it was published in April of 2020. There was no inflation at the time. In the next 3 months, there was mildly negative inflation, but then it all started. You got to the back half of 2020, inflation took off, and by middle of 2021, it was as high as an annual rate of 10.8% at one reading. It was 0.9 was the actual monthly number. The Fed looked the other way, said it was transitory. Janet Yellen said, no, this is not a big deal. It's all supply side constraints. Look at all the shipping that's stalled and so forth. But it wasn't that. If that was the cause, the supply constraints or energy, then when supply constraints went away, the prices would have gone right back down, but they didn't. Inflation continues. Prices are still going up, even though supply constraints went away. So that's a silly argument. And same thing with energy. Energy prices, you remember the barrel price got down to mid-50s at one point last year. That's way below where it was when we started the pandemic. So you can't blame inflation. Everybody wants to blame it on this or that, but what the government should do, and particularly Janet Yellen, who's a friend of mine, by the way, I tried to recruit her at Cornell, and she's a brilliant economist, but she kind of blew this one. She argued in the early days of the Biden administration that rates were zero and they were going to stay there so we can go big. Doesn't cost anything to finance government debt. And that turned out to be not be very accurate. We're paying more for interest on the debt today than the total we spend on defense spending and Medicare. We spend more on just interest payments. We spend $1 trillion a year on interest payments. We're spending $900 billion in total on Medicare and defense. So we have a lot of issues here. And the big key is, what's the story on inflation? And I think the story is we're going to see more of it. It's not going to go away. Now, the Fed may decide that it's going away. You may see a dip briefly in interest rates, possibly. And I think you will see a little bit better CPI numbers because there are a couple of favorable wins. The price of oil has dropped a little bit. And it looks like housing may be leveling off in terms of the pricing, and housing is a third of the index. And energy, if you put it all together, include electricity, is about a third of the index. So you're going to see some numbers, my guess is, over the next 3 or 4 months. People will be cheering, oh, look at this, 0.2 for the month, 0.1. Now, you got to multiply those numbers by 12 to get the actual inflation rate. But that's going to feel good. And if yield comes in on the Treasury bill market, which currently is around 5.4%, if that comes down into the low fives, the Fed will cut rates if that happens. So keep your eye on the T-bills. Keep your eye on the 3-month Treasury bill, the 6-month Treasury bill. If you see that dip below 5.25, if you see it in the 5.10 area, just watch it. You can see it, by the way, if you just pull up the CNBC app and go to the second thing on markets, and you'll find T-bill yields all day long and all night long. You can see the numbers. If that dips below 5.25, you can almost take it to the bank. The Fed will cut rates. And if it doesn't, you can almost take it to the bank. They won't. That's the key number in the T-bill yields. And so that might happen, but the only way it's going to happen, in my opinion, is the Fed abandons quantitative tightening and begins to goose the money supply again. Well, if they do that, what do you think is going to happen? We're going to end up with more inflation. So they're at the horns of a dilemma. If they want lower rates, which the public is really asking for, particularly the business community and commercial real estate and areas like that, where you can't get long-term financing. There is no fixed rate 30-year mortgage financing in commercial. And I know I sit on the board of a public commercial REIT, and you are the biggest commercial operator I know. So you're very sensitive to the issue also. So rates do matter quite a bit. And so the Fed will be under a lot of pressure to do something to lower them. But inflation is likely to push it the other way. So it's going to be a difficult situation. I think the Fed will eventually cave. And what they'll do is go back to quantitative easing, and we will begin to live with inflation forever. I don't think the Federal Reserve has the will to stop the inflation. And I know the politicians don't. We're running 6% deficits. GDP, for example, is about 30 trillion area, roughly in that area. We're running 6% numbers. So 6% of 30 trillion, that's 1.8 trillion per year in deficits. We used to run 1.5% deficits back when we thought deficits were a terrible thing. Oh, look at this. This deficit is so big, it's going to kill the economy. Well, they were like 1.8% back in those days. Now it's over 6%. And if you look out, this is not 6% this year and going to decline. This is 6% as far as the eye can see. And the only way you could keep it at 6, you're going to have to abandon Social Security and Medicare because they're going to run out of money. So everybody's assuming we'll just eliminate Social Security and Medicare, and then we can kind of hold it at 6. You can't hold it at 6 unless you do. Well, I don't think you're going to abandon Medicare and Social Security, so I think you're going to be staring at 8, 9, 10% deficits. And I don't want to scare anybody, but read up on Turkey if you want to know where this route takes you. You didn't ask me what the answer is. So let me pose the question to myself. What is the answer? The answer is both political parties, neither one of them are innocent here. You know, the Republicans say it's all the Democrats' fault. Democrats say it's all the Republicans' fault. They're both guilty. Both parties have voted not only for, people talk about Republicans voting for tax cuts, but they vote for spending as well. A lot of spending. They're right in there with the Democrats. Oh, I can't wait to spend more money. And we don't have it. We're up against the wall, but both parties need to sit down, and the right number for the federal government is the historic number of about 20%. 20% of GDP is about what the federal government can spend. That's about what we can tax people. There's an optimal amount. I mean, if you tax Jeff Bezos 150%, you can only do that once. That's how people are thinking. They're going to tax all the rich people, but that's not a continuing stream of income. The only way you get income for the country is you tax the middle class and the lower middle income. That's where all the money is. It's not in Jeff Bezos or Elon Musk's hands. All you can do by raising their taxes is scare them away, and they'll move to Singapore and do whatever they're doing over there. If you want, you're not going to get a lot more revenue than you got. 20% is about it. So you need to restrain spending. Spending is currently 26%. You need to bring it back down. So you need to get Joe Republican and Sam Democrat in the same room and say, here's what we got. We got this to spend. Now we'll give you, a little paper dollars that you can spend, and we'll get right up to that number. And then let's agree that that's all we can spend. You can't do everything. Just think of your household. If you're running your household, what do you want? Well, you want a new car, new house. What else? Your best of food. Hey, let's go watch the Cavaliers play in the Super Regional. What are the tickets? 500 apiece. Yeah, let's do that. Hey, let's go to Europe. French Open's going on. You can think of a million ways to spend money, but we all look at our income before we go crazy, because we know if we do that, eventually we're going to be in trouble. Well, that's where the U.S. government is now. We are in big trouble, and so is Europe, and so is Turkey, and almost every nation in the globe. The only nation that's probably not in big trouble, although everybody thinks they are, is China. But if you wave them aside, and maybe Singapore as well, But Japan's in trouble and we're in trouble. Everybody is. Everybody has spent way more than they could because there's always been a demand for U.S. treasuries and a demand for Japanese government bonds and a demand for high-grade European bonds. But people are beginning to lose interest in that.
And I think what people want to hear is that debt today is $36 trillion. We bring it a little less than $5 trillion, which means if interest rates go to 10%, there's no money for anything. There's no money for Medicaid, Medicare, Social Security, air traffic controllers, paving roads, federal grants of any sort. Would you mind speaking, please, to where the debt is today, what federal receipts are, and what happens when rates go to 10%, or if they do?
Yes, there's some easy metrics to remember. One of them is that federal receipts tend to run about 20 to 21% of GDP. So if I told you what GDP was, you can do a quick calculation and come up with the revenue. We're staring at about 30 trillion, roughly. And so you can think in terms of about 6 trillion in potential revenue. That's what you've got available. But we're spending closer to 8 trillion. So the budget just doesn't work. And there's no way to get that 8 trillion down to 6 trillion because all of it has been passed. A lot of it's entitlements. So you got 6 trillion coming in the front door and 8 trillion going out. And as you look forward, the spending number just keeps going up, and so does the tax number, but the tax number is losing ground. So that 1.8 trillion just gets bigger and bigger. So the CBO estimates that you'll see 50 trillion by 2050, but they're assuming we're going to go back to 2% inflation and we'll be able to finance the national debt at 2% interest rates. That's not very likely. You'll probably hit 50 trillion. It depends. If we keep going at the rate we're going, we'll hit 50 trillion earlier than that, maybe 2040 or an earlier year. That's not very far away. And start thinking about what interest rates we may be looking at. Let's say we're looking at 5%. 5% of 50 trillion doesn't leave a whole lot of room for doing anything else. And if you think this can't happen, this has happened to countries in the past. We're not going to be the first guy at this rodeo. Turkey's at the rodeo now. If you really want to enjoy how countries deal with all this, one way to do it is just keep printing money. That's one answer. We can run inflation at 100% a year if you want. And of course, poor people will just evaporate in a country like that. Rich people don't evaporate because they have assets, and their assets will tend to grow in that environment, at least in price. Home prices will go up, for example. But if you don't own your own home and you're a renter, you're just done for. And this current inflation is doing that anyway. The current inflation, we've increased the price level since the pandemic started by 30%. So if you were making, in Virginia, for example, the average family income 3 or 4 years ago was about $70,000 a year. That was the average family income. So 30% of that is $21,000. So it's as if you just tax them $21,000, but not just 1 year. Every single year you tax them, and it's not going away. That tax is not going away. Price level is not going to fall. Inflation is just going to slow down. So, hey, maybe the tax will only go to 32% next year or 33. It's not going to go down to 27 or 8. And who's getting hurt? The people at the very bottom of the income pile. It's savage. Everyone who has below the 70,000 and below in Virginia is getting slaughtered. They don't have the kind of assets that are going to appreciate in this environment. They don't even have, most of them don't have assets. They live hand to mouth, and everything they can do to get their kids to school and feed them and do all that. Heaven help them if they wanted to send them to college. That's really gotten ridiculous. So you're really pounding, what you're doing is you're dramatically increasing the tax on poor people by running these inflation rates. That's why rich people don't care. They do not care. Inflation doesn't bother them unless they've got a lot of commercial real estate debt or something. But even there, they've got other things at work. And you know that. Some homes in some areas have tripled. The area where I live, homes doubled and tripled, except on low income, but they're mostly renters. And so the rents all went up for them. So inflation it's the most unfair tax of all. You don't get to vote on it. Nobody gets a vote. Some poor guy who's making $40,000 a year, he doesn't get to vote on inflation tax, but he pays it. he and his family pay it. So his chances of making the big time and getting out of one income bracket and going to another just go away. So inflation's a terrible thing. And the problem is that unless you restrain government spending in some way, and it should be easy to do. I mean, we do, I think back when I was a kid, Hunter, that was before your grandparents were born probably. But I think back when I was a kid, we never thought the government should be doing all this. And it doesn't do anything well. Those of you who get your mail from the post office know that. I rode Amtrak last week. It was hilarious. I got on the Amtrak train. I thought I was going to get on in Fredericksburg. There were no ticket agents, and some poor lady, they never tell you which track the train's coming on. She had all these bags. She missed her train heading to Washington, D.C. Then when we came back from Union Station, they led us to the wrong platform. 250 people lined up to the wrong platform to go to the wrong train. That's how government works. If you privatized Amtrak, you wouldn't run into that. But nobody has any incentive to make it work. There's too many things the government does that private sector should be doing, and that would make it cheaper, and it would also get the right price. We all think because we have a government service that it's free. We always think of the government as it's free. That doesn't cost me anything. Well, think about that inflation tax you're paying. It does cost you quite a bit.
What happened in the 1970s, and what was the resulting effect on interest rates going into the early 80s?
Well, it was interesting. Let me start at the end. One day, my grandmother called me when I was at Smith Barney on the trading floor, and she said, "Buddy," she called me Buddy, if you can imagine that. She said, "Buddy, I have saved $10,000 and I want to buy something really safe and secure. What do you recommend?" I said, "Grandma, we have a 30-year auction coming, a 30-year U.S. Treasury, and they have never defaulted, Grandma." So she said, "Well, will you buy it for me?" I said, "Sure." So the auction came. It was the 14s of Novi 11. Now, what does that mean, the 14s of Novi 11? 14 means it paid 14% if you buy it more or less at the auction price. 14%. That's a 30-year bond. And it would mature on November 15th, 2011. So that tells you the day the conversation took place. It took place 30 years before 2011. So it was in 1981. I was sitting on that desk. So I bought it for her. The following week, she called me and she said, "How's my bond doing?" I punched it up, dropped from 100 to 96, down 4% in 1 week in price. I said, "Grandma, it's a busy day here. Can I call you back?" And so she said, "Sure." So the following week, she called me and she said, "How's my bond doing?" And I punched it up, 92. It lost 8% 2 weeks. If she went to sell it, she'd lose 8% of her money. And she said, "So how's my bond doing?" And I said, "Well, Grandma, the government has never defaulted on a bond. If you live another 30 years," she was only 85 at the time of this conversation. I said, "You live another 30 years, you can collect all your payments and principal." And she said, "Oh, thank you, grandson." So the following week she called and she said, "I looked in the paper and I saw 84 next to my bond." And I said, meaning she was down 16% in 3 or 4 weeks. And she said, "The other thing I saw was a 16.8% on the same line." What does that mean, 16.8%? And what does 84 mean? And I said, "Well, Grandma, we have to identify these bonds by what we call CUSIP numbers. That identified the bond, blah, blah, blah." Grandma saw right through me. That bond was trading 16.8%. If you bought that bond from my grandmother at 84, which means you would have paid $8,400 for a $10,000 Treasury 30-year bond, it was yielding 16.8%. Now, can you imagine where mortgage rates were then? This was 1981.
And where was prime? Where was a lot of
prime was 22. Mortgage rates were sitting around 18, and people are happy to get them. Oh, they was happy to get them. Oh, 18%, that's nothing. And where was the inflation rate? 14. And where did this all start? This is 1981. It all started in 1970. Where were rates then? Inflation was 1.5%. The rates were in the 2% area. But we decided we could spend a lot of money. So we were fighting the war in Vietnam at the time. And the president at the time was, I think it was Lyndon Johnson, as I recall. And he believed you could do everything. And we could do the new great society. We could do everything. Everything was possible. Well, it wasn't possible without running inflation. So you had massive increase in inflation. So you had inflation at 14%, and the prime rate was 22%. These were the numbers. And people look at these numbers now and they think they're bad. But if you'd like a roadmap to where you might be going, just go back and pick up a newspaper in 1981. Go to the New York Times, say, New York Times, give me any newspaper in 1981, or Wall Street Journal or anything, and you'll read about it. And the chairman of the Federal Reserve at the time was Paul Volcker. He had been appointed by Jimmy Carter in 1977. And what he did is he said, the money supply has been growing too fast. So he made it grow slower. The economy cranked down, and that was the end of inflation. Within 5 years, inflation was 2%. So it can be beat, but not without a punishing recession and a major collapse in the money supply. And that's not going to happen as far as I can see. I think we're maybe facing the reverse. So that's where we stand.
What extent do you think the prosperity of the last 40 years as a result of declining interest rates as the yield on the 10-year has declined fairly steadily for the past 42 plus years?
Yes, by keeping the interest rates artificially low. Ben Bernanke wrote a book. Ben Bernanke was the chairman of the Federal Reserve. He was appointed in 2008 to replace Janet Yellen, of all people. And Bernanke wrote a book describing what happened from 2008 to when he stepped down and Powell took over. And he very explicitly said, we did quantitative easing to keep rates low. They expanded the money supply to keep rates low. Well, why would you do that? What that means is people are making investments at the wrong interest rates. And interest rates, it's surprising now when you think about it, but the 30-year Treasury bond was yielding 1.7% 4 years ago. The 10-year was under 1%, and T-bills were earning 0.11% per year. That's where rates were. And when rates are that silly and that out of line, all kinds of bad investments get made. And we're going to pay the price for that now that rates have gotten a little bit more normalized. You create huge inefficiencies in your economy when you do that. And we've managed to do that here. But Bernanke just admits bald-facedly in the book was published last year. Ben Bernanke is the name, Bernanke. Read the book. It's shocking that an economist of his stature would think that it makes sense to expand the money supply, and he did. And money supply increased 7% every single year from 2009 to 2019. Inflation stayed subdued. It stayed around 1.5% because the cash piled up in all these endowments and foundations, because you had the biggest stock market rally in history. And people are willing to hold money if the interest rates are zero. When interest rates all of a sudden went to 5%, people decided I'm tired of earning zero. I think I'll go put my money in a money market. And all of a sudden that money the money markets started getting spent, and inflation took off, and it's not coming to an end anytime soon.
The yield on the 10-year as of the last 5 minutes is 4.33. The yield on the 90-day is 5.39. The yield curve is inverted.
Yeah, notice T-bill yields have not changed. That's the same yield on the 90-day that you would have seen in October, November, December, last week, last month. And that's the yield that matters in terms of Fed policy. As long as that yield is up there at 5.4, they're not going to lower
the 90 days yields.
They're not going to lower the overnight rate. That's what really drives them, is that number. So keep an eye on that number. Don't listen to all the people that talk about what Powell had for breakfast or something, the Fed chairman. That's not really the major issue. The major issue is, does he have room to lower that rate? He wants to. He'd love to see T-bills at 5.10, and he can get them there. Just go buy $1 trillion worth of them, push a button and buy $1 trillion. He's a little reluctant to do that because that shows up. He has to reveal that. But Powell would like nothing better than to get overnight rates down. He's under tremendous pressure to do that. But I don't think he'll be able to do it unless he decides he wants inflation long term.
Professor, there's a famous story of you at the options department at Smith Barney. You get a call midday. You tell the caller you're out in the middle of the floor. You tell him to hold. Is that a true story?
That's a true story. I can tell you the stock. The stock was National Semiconductor. And it was late in the day, and this was one of my favorite customers. And I was on the phone with somebody, and it was about 10 minutes to 4. And somebody said, "Hey, Bruce is on the line here." That's actually his real first name. And I said, "Tell Bruce to hold." And so 4 o'clock came and went, 4:15 came and went, options weren't trading, and these options were going to expire the next day. So they were essentially worthless because the stock was higher than where you could exercise them. But National Semiconductor announced something at the close, and stock was up 20 points. So my client made several $1 million. So he calls me and he says, Eddie, you were so right. Oh, you really know everything. And I said, "Bruce, I hate to tell you, I was just trying to get you to hold on to the phone." He said, "No, Eddie, you're just so modest." So he took me to Elaine's, that famous restaurant in New York. He told his whole family I'd made him all this money. I didn't make him a nickel. I didn't even know why he was calling. But it is a true story. And everybody who was in the derivatives area at Smith Barney knows that story. It's a very famous story.
Professor, thanks for talking with us today. We'd like to continue this and continue to understand where we are on the budget, the U.S. budget, and where we go and how it unfolds. It seems like we're in a spiral, but let's continue, and good start for many to come.
Thank you for joining us for the Rubber Meets the Road Economics podcast. If you enjoyed the discussion, remember to subscribe and stay updated with future episodes. Join us soon for more conversations about modern economics on the Rubber Meets the Road Economics podcast.